Let's talk about the rough start to your career. You're 27 years old when you joined Carl's firm in 1997. Your first few deals were disasters. You backed two website design startups, Nervewire and Eclipse Networks, right as the dot-com bubble burst. You invested $100 million in these two deals and lost most of it. To make matters worse, Thoma wasn't doing well either. The firm had made some poor investments in the oil and gas business and telecommunication business, which altogether made your firm one of the worst performers in private equity at that time. So let's talk about mistakes. When we make mistakes, one of the goals is to learn from them. In my own portfolio, we make a ton of mistakes and it's never fun to lose money. But there are very important lessons to be learned. When we make a mistake, I believe we would learn more from our mistakes than our successes. What did you learn about these deals and how did it change your focus? And how did the dot-com bust play a huge role in your investment strategy going forward?
First, I was trying to go too fast. And maybe that was also a product of the environment that I was in. Small San Francisco office in the middle of, you remember this well. One of the stocks I bought in my personal portfolio at the time was Akamai.
Okay.
So
pre-IP, did you get friends and family shares? Because I cringe when everybody I know bought it afterward. I think the stock closed at the first day. Went public at 28. It closed the first day at 144, and it ended the year at 345, giving us a market cap more than Chrysler, GM, and Ford combined on $3.2 million in revenue, 90% of which came from Apple.
Believe me, I did not get any friends and family. I bought it on like $250 or something like that.
Right.
But I held it through. But things were happening so fast. And even culturally in San Francisco, things were happening so fast that my classmates from business school were getting net worths of $2 million over options in a really, really young company that was about to go public and all this stuff. So being in that environment and having, for some reason, an affinity towards tech, I said, well, why don't we do industry consolidation in IT services? Since we didn't want to, quote unquote, take the risk of actually investing in a product company because that seems scary. Isn't that strange? So we ended up investing in a tough business model, in businesses that were part of a bubble, obviously in hindsight, that didn't add as much value, and that were very difficult to run. And they failed quickly. They didn't do well. I am proud of the fact of how they failed because I am still friends with the founders and the leadership of those companies, and they're good leaders. It was wrong business, wrong place, wrong time, a number of factors. But what I mostly learned from that is that style of investing did not fit me. I would not have fit as an associate in Draper Fisher Jurvetson, even though I think the world of Tim, and I didn't beg him for a job when I didn't have any. I fit better coming from law school and investment banking and perhaps a more conservative culture in Puerto Rico. I fit better in a place where you could analyze cash flow and think about established companies and do quite a bit of analytics on revenue quality and margins and start thinking about operations with management that maybe has been around for a number of years. That's also the firm that I joined. That's what Carl Thoma does. That's what he's about. And that's one of the reasons why they may have been a fit. And I was trying to do something too different that didn't even fit myself. There was a meeting that we had when all those things were not going well. But it was early, not going well, but early. There weren't failures yet. And I was pushing for another deal. And I remember mentioning to Carl, well, Carl, if you want to make return, you have to take risk. And he looked at me and he said, yes, but not that kind of risk. And I always remember that. Take the risk that fits your makeup and that you can assume and that you can deal with in tough times. And there I had no idea, right? For example, when those companies needed cash, we weren't part of the venture community. to come in with a bunch of friends and finance it and see how we could keep it afloat. We were kind of there on our own.
Let's talk about the turnaround. You do some bad deals and you learn from them. You become a software expert. Then 2002 rolls around. You've been at the firm for 5 years, and then Carl lets you lead the acquisition of a product distribution software company named Profit 21. It was the first software deal your firm had ever done and was one of the earliest deals in the software industry where a private equity firm bought a public company and took it private. At that time, lenders were very hesitant to provide capital for these kind of deals, so you did the deal borrowing very little money. The company was doing $40 million a year in revenues at the time. It was trading at one-time sales. Usually, when a private equity firm buys a company, they often get rid of the CEO and bring in their own management team. You didn't, and you still don't today. You kept the company's CEO, Chuck Boyle, and you worked alongside him to boost profits by buying your competitors. First company was a company called Fastback, which is based in San Diego. And you work out of the Fastback owner's garage for 5 days, going through hundreds of contracts to see if the deal made sense. It's a lot of grunt work. After you bought Profit 21, you made 7 more acquisitions, which doubled the company's revenues to $80 million. And a little over 3 years later, you sold the business for $215 million, making your investors 5 times their money. So let's talk about actually how you do it. Tell us about the economics of software, your investment strategy, chasing rabbits, and making peace with the past.
Wow. So once again, I am impressed because I don't think anybody else knows about Fastback, that first add-on acquisition. One of the thoughts that we had is if that deal went right, we could then do so many more add-on acquisitions for Profit 21. So that's one of the reasons we were so hands-on on that first opportunity. I remember going through, I would stay late at night in the garage. The owner would let me stay there. And I would go through the paper change orders of all their customers, A through Z. And one of the things that I noticed there, which in hindsight, we should have seen, the world should have seen, there so much growth and there were so many change orders that were related to Y2K. And then they stopped. I was looking at that one night and going, this is just amazing. It was all right here. Who did not notice that there was a huge blip of growth that was not sustainable due to people investing around Y2K, but that's another matter. We did the opposite of the mistakes that we had made on those failed deals. Those failed deals were about buying expensive, trying to chase momentum, and not worrying about profits. When the internet bubble burst, buying software meant 100% the opposite. It was buy cheap, buy safe recurring revenue and stability, and buy 90% gross margins. If something just miserably failed, let's do completely the opposite. The economics were so obvious at the time. You would buy these companies for 2 times maintenance revenue, 1 times total revenue. The business model was 50% variable, 50% maintenance or recurring at the time because it was a product business. And you could theoretically drop down 50% of your maintenance revenue to the bottom line. One way to look at it was you could pay for all the cost of the company with maintenance, and every variable piece of revenue was profit. That was the other way of looking at it. And there was an academic reason for it when you separated these companies into a manufacturing company and into a distribution company, and you assign royalties because there are many that work that way. It absolutely made sense. It was also a model where cash flow is greater than EBITDA because in software, customers pay you ahead of delivery of the product, so you have negative working capital. And it was a business that, between having these embedded pieces of software that customers find it hard and expensive to replace, combined with intellectual property protection, it was just a really stable place to be. The consolidation economics were even better because if you were buying customers and putting them in your platform, you could typically get a 60 to 70% EBITDA margin from the acquired customers because you didn't need overlapping R&D, overlapping sales, and obviously overlapping G&A. The same thing applied if you were buying products because you could put them through your distribution channels. So we came at it with an industry consolidation angle. That was a way maybe that we sold it to the rest of the partnership. This is one of the best consolidating sectors there are, and it's cheap right now. Let's go try it.
There's 75 subscription software companies now worth nearly $1 trillion that you can target versus fewer than 20 worth less than $100 billion. So you're excited about the opportunities today.
It's not even close. Back then, we were in a tiny niche, and software itself was not that interesting, right? Back office oriented, on-premise, difficult to implement, all that. Now software is clearly becoming the business of every company. Digital transformation is still at its infancy. We still haven't deployed a fraction of what's available from a technology and IP standpoint. And now groups like us are not at the fringes of the industry. We get to buy market leaders. And sure, we have to pay multiples higher, but these companies are growing. I mean, you see it, and that's what you invest in, and that's what Akamai is. They're growing at really rapid rates, at scale, and changing underlying industries. So being part of that is just so exciting. I feel that our team, the way I look at it is, we've been training for this moment, and we almost are anxious about doing really well at it because this is a point in time that really fits our background and our history.